Okay, let's talk about something literally almost all of us pay for every single month. But, we rarely actually think about it until disaster strikes. Insurance. Now, you might view it as just this essential everyday safety net, but behind the scenes, it's a highly calculated, heavily data-driven financial machine. Using insights from Bima Bazaar and The Street, we're going to use this explainer to break down exactly how these companies turn your monthly premiums into massive, mathematically guaranteed profits.
Section 1. The 3% Reality. The Stark Odds of Insurance.
Okay, let's dive right into this. Before we can even begin to understand the complex profit strategies, we have to look at the basic math. And I want to hit you with a staggering statistic right out of the gate. According to industry data reported by The Street, out of every 100 customers paying their insurance premiums year in and year out, only 3 actually file a claim. Just 3. I mean, think about that for a second in the context of literally any other business. You have 100 people paying for a service, and only 3 of them ever actually draw from it in a given year.
That leaves a massive 97% of people who do not file a claim, completely dwarfing the tiny 3% who do. This simple reality is the absolute mathematical foundation of the entire business model. It heavily favors the insurer. You're paying them to take on your risk, sure, but the statistical reality is that the vast majority of us will simply hand over our money month after month and never ask for a single dime back. So what does this all mean? It brings us to the most logical next thought. Where does the rest of the money go? If 97% of the people paying into the system aren't taking money out of it to cover a ruined car or a health issue or a damaged home, what happens to all those monthly premiums? How does that pool of cash translate into the operations and the massive profits these companies generate?
Section 2. 2 Pillars of Profit. Unlocking the revenue machine.
To answer our question, we have to look at the twin pillars of the insurance revenue model. Based on the detailed breakdown from our sources, insurance companies build their entire business on 2 main revenue streams: underwriting profit and investment income. It's an incredible balancing act, really. On one side, you have the fine art of pricing risk effectively, that's underwriting. And on the other side, you have the massive financial leverage of taking upfront cash reserves and investing them. Let's break down exactly how each of these pillars holds up the house.
We'll start with the mechanics of the underwriting model, which is amazingly simple when you break it down. Step 1, collect premium. Step 2, pay operating expenses and claims. Step 3, keep the difference. Underwriting is the core process of assessing risk, and the ultimate goal here is always to ensure the collected cash vastly outpaces the claims paid out. If a company collects $5 million in premiums and only pays out $4 million in claims and overhead, well, that remaining $1 million is pure underwriting profit. The Street points out a brilliant comparison here. Think about an auto manufacturer. They have to spend money up front to build a car before they ever see a dime from a customer. Insurers? Completely different. They put no money up front. They just collect your cash, hold it, and manage the math to make sure they keep the difference.
But here's the thing. They don't just put that difference in a vault. This is where the second pillar comes in, investing the upfront cash reserves into low-risk assets. Because insurers collect your premiums upfront, long before any claims ever hit, they sit on massive amounts of unspent cash. In the financial world, this is called float. They take this float, this huge cash reserve, and invest it heavily in government bonds, corporate bonds, real estate, and stocks. So they aren't just keeping the difference from the underwriting side, they're actively growing that massive pool of unspent money every single day on Wall Street. And if their investments happen to go south, well, the Street notes they often just increase the price of their premiums, passing the losses right on to the customers. In fact, the mechanics of this investment float are so incredibly lucrative that it caught the eye of one of the greatest financial minds in history. As The Street reminds us, billionaire Warren Buffett invested heavily in Geico and opened his own massive reinsurance firm for this exact reason. Getting money up front to invest, knowing you might never even have to pay out a claim on it, is a spectacularly reliable way to generate income. As the source says, Buffett knows a sure thing when he sees one.
Section 3, the hidden cash windfalls, beyond the basic premiums.
Now, what's really interesting about this is that profit generation doesn't actually stop at those 2 main pillars. There are a couple of highly profitable, lesser-known scenarios that happen when consumers change their minds or just make missteps: cash value cancellations and coverage lapses. Let's look at cancellations first. Say a customer with a whole life policy sees they've built up thousands in cash value and decides, you know what, I just want the money, so they close the account. The insurer is perfectly happy to oblige. Why? Because when they pay out that cash value, their liability completely ends. They keep all the premiums you've already paid, they pay you out with the interest earned from their investments, and they keep the remaining cash. Then there's the coverage lapse. That's when a customer simply fails to keep current on their payments and the policy expires. As the street describes it, that's another cash bonanza for insurers. Think about it. A coverage lapse means the insurance company gets to keep absolutely all of the previous premiums you paid over the years, while entirely shedding the liability of ever having to pay out a claim. The consumer is the one who took on all the risk of keeping the policy active, and if they slip up or outlive the coverage timetable, the house walks away with the money, completely risk-free. Section 4. Protecting the house. Risk management strategies. So, to keep these profit pillars standing tall, insurers have to meticulously protect themselves from unpredictable, catastrophic losses. Like if a hurricane levels a city, that 3% claim rule we talked about, yeah, that gets thrown right out the window. To prevent total disaster, insurers use 4 main strategies outlined by Bima Bazaar to minimize their exposure and mathematically guarantee their overall stability. They use risk pooling, which means spreading the risk across so many people that a few high claims don't ruin the whole pool. They use reinsurance, actuarial analysis, and strict claims management, meaning they fight tooth and nail to ensure only totally legitimate, non-excessive claims are actually paid out. Let's look a little closer at 2 of these crucial concepts. First up is actuarial analysis. Basically, this is the practice of using advanced mathematical models to predict the likelihood of claims and set premiums accordingly. I know it sounds like dense jargon, but this is exactly how insurers use your age, your health history, your credit history, and the value of your assets to calculate risk. If the data tells them the risk of you making a claim is too high, they either won't cover you or they'll charge you significantly more. It's their absolute ultimate defense mechanism to make sure the math stays comfortably in their favor long before you ever sign a contract. Then there is reinsurance. This is literally insurance for insurers. They spread the risk among multiple companies to prevent massive catastrophe losses. Going back to that hurricane example, if a natural disaster creates a sudden surge of massive claims, a single insurance company doesn't want to bear that entire burden alone and risk bankruptcy. So they actually go out and buy their own insurance to cap their losses. It's a fascinating structural concept, a safety net built specifically to keep the industry solvent no matter what crazy catastrophes happen out in the real world. Section 5. The ultimate trade-off. The customer's dilemma. Okay, we've seen exactly how the machinery works, from the underwriting math to the investment flow. So the objective reality we have to summarize here is this. Insurance is a vital safety net built on a calculated, data-driven financial formula. As consumers, we genuinely need that safety net, right? It provides undeniable peace of mind and protection against absolute ruin for our families, our homes, and our cars. But as we've learned from our sources today, we have to acknowledge that we are actively funding a heavily tilted system. It is mathematically engineered from the ground up, from the 97% who never file a claim, to the massive investment portfolios, to the actuarial analysis, so that the house always wins. Which leaves us with one final, pretty provocative question I want you to take away from this explainer today. You pay them to take on your risk, but who is really winning the bet? It's definitely a fascinating dynamic to ponder the next time you sit down to pay that monthly bill. Thanks so much for joining me for this explainer. Keep asking questions, keep looking at the data, and I'll catch you next time.